Okay, let's imagine this picture for a second. A normal Tuesday, you popped into the grocery store not for a big haul, just the basics: milk, eggs, bread, a pack of chicken breasts, a jar of peanut butter. 5 items. The cashier scans everything, and you look at the screen. $72 for this, and you just stand there looking at the number. Because in your head, there is a very clear memory 3 or 4 years ago, this would have cost about $45. You aren't confused. You aren't exaggerating. That's how it was. But here is what really pulls the rug out from under your feet. Remember 2022? Gas skyrocketed to 5. In some places, $6 a gallon. People were furious. Then the situation calmed down, and gas went down. Now the national average price is hovering around $3 and change. But it didn't return to $2.50, where it was in 2020. It simply settled at a new, higher level. And it's like this with literally every category: groceries, rent, insurance, restaurants, subscriptions. Everything crawls upward, sometimes sharply, sometimes invisibly, but backward never. And the question that no one gives a normal answer to is, why? Supply chain problems have been solved. Oil has stabilized. The pandemic chaos is over. So why do prices stay right where they spiked during the crisis? Most people shrug: inflation. And yes, inflation is present here. But that's like answering the question, why are you wet, with because of water. Technically correct. Completely useless. It doesn't explain the mechanism. It doesn't explain why the system works like a ratchet only in one direction. Today, I will break down what is actually happening: the economics, the psychology, and the specific corporate strategy behind it. And most importantly, exactly what you can do about it. Because when you understand how this machine works, you stop being the one it grinds up. My name is Sam. On this channel, I break down how money works in reality without the fluff. Subscribe and hit the like button. It really moves the channel forward. Let's go. Inflation is not the answer. It's an evasion of the answer. Let's start with the obvious. Inflation is real, and I am not going to deny that. The CPI records that since 1913, prices in the US have grown by an average of 3.2% per year. A basket of goods that cost $100 in the year 2000 costs about $188 today. In less than 25 years, purchasing power has dropped almost by half. The standard explanation: the government prints money. There are more dollars chasing the same amount of goods prices rise. The M2 money supply grew from $4.6 trillion in 2000 to over $21 trillion by the beginning of 2022. A colossal growth. But here is where the logic cracks. If inflation is only about the money supply, then when it shrinks, prices should at least roll back a little. In 2022, 2023, the Fed raised rates from 0 to more than 5%. The money supply actually contracted by $1.4 trillion for the first time in decades. And what did the grocery receipt get smaller? Did rent decrease? The average car insurance is now about $2,150 a year, 26% more than 3 years ago. No, nothing got cheaper anywhere. This means it's not just about the money supply. And this other thing is much more interesting. Because prices are not just a reflection of the amount of money, they are a reflection of the system of incentives, expectations, and corporate behavior. And when these factors change, they can keep prices high even when the money flow begins to shrink. And if you understand this mechanism, you will start to see inflation not as a random process, but as a managed structure in which far from everyone wins. Because in this system, what is more important is not how much money is in the economy, but who controls pricing and how decisions are made. The deeper you understand this, the less you believe in simple explanations, and the better you see the real picture. This means you gain a chance to act consciously, rather than just adapting to rules that someone else has already set for you. The ratchet effect: 3 forces that explain everything. In economics, there is a concept called the ratchet effect. Prices move up easily, but are extremely resistant to moving backward. Like a tool, it clicks forward, forward, forward. But the mechanism won't let it go back. There are three specific forces behind this. First, wages do not go down. When a company's costs grow, one of the main line items that also grows is wages. When everything around becomes more expensive, employees demand a raise. It's logical. Now, a question. When the crisis ends, do wages decrease? Imagine. The boss comes to you with a smile. Great news. Oil got cheaper. We're cutting your salary by 8%. You get up and leave. Everyone leaves. Economists call this downward wage stickiness. And since labor costs make up 60–70% of all business costs in the US, even when external pressure disappears, the internal cost structure remains high forever. No cost growth, no incentive to lower prices. Second, changing prices costs money. In economics, this is called menu costs. We aren't just talking about new price tags. Updating all systems, contracts, algorithms, and databases for a large company costs millions. When costs grow, the company goes for these expenses. Otherwise, they lose money. When costs decrease slightly, the savings might not cover the cost of reverting prices back. Mathematically, it's easier to leave everything as it is. Third, your brain works against you. In behavioral economics, there is a concept called anchoring. People evaluate the fairness of a price not objectively, but relative to the last price they saw. That is the anchor, and everything else is evaluated relative to it. Example: for years you paid $3.99 for yogurt. In 2022, it started costing $5.49. You were outraged, but you continued to buy it. After a few months, $5.49 became the norm. The new anchor. Now the company runs a promotion. It lowers it to $4.79, and you feel relief. Even though $4.79 is 20% more expensive than the $3.99 you originally paid, your brain compares it to the crisis peak, not the historical low. Companies know this perfectly well. Large corporations literally have teams of specialists in pricing psychology, a real profession, their task, to understand and use these mechanisms. A sharp jump in price during a crisis, then a small decrease just enough so that you exhale and reset the anchor to a permanently higher level. What bosses told shareholders directly? In 2022–2023, the term greedflation appeared. Let's look not at words, but at numbers. The Economic Policy Institute published an analysis. Corporate profits accounted for about 53% of price increases from mid-2020 to late 2023. More than half of the price hike you felt is not increased costs being passed on to you. It is margin expansion under the cover of crisis. The Federal Reserve Bank of Kansas City confirmed. Companies with greater market power were able to increase markups significantly more than their actual costs grew. Here is the scheme. Supply chains broke, costs grew by 10%. You raise prices by 15%. You tell everyone, we had no choice. Technically, true costs did grow. You just raised prices more. You used the crisis as a cover. This isn't a conspiracy theory. The CEO of Hostess Brands said on an earnings call in 2023 that the company took strategic pricing actions and was pleased that elasticity remained favorable. Translation: we raised prices, and people kept buying. Executives across the industry use terms like pricing power and favorable elasticity on recorded public calls. They told shareholders in plain English. And this is the key point. If the consumer continues to pay, the business has no incentive to lower prices back. Why give up margin that the market is willing to tolerate? This isn't immorality, it's rational behavior in conditions where competitors are doing the same. The market doesn't punish such actions, it rewards them through profit growth and company capitalization. Shareholders are happy, the board of directors is happy, the CEO gets a bonus. The system works exactly as designed, just not in your favor. Over time, this becomes the new normal that everyone adapts to. without even noticing how the baseline price level has changed. And that is why a return to old prices almost never happens, because the system has already fully restructured to a new level, and no one inside it is interested in moving backward. The math that should alarm you. Suppose you earn $65,000 a year. With inflation at 3.5% per year, in 10 years, you will need about $91,700 just to live the same way as now. In 20 years, $129,600. In $3,183,000. According to Social Security Administration data, the median wage growth is about 3–4% per year. That is, you are running as fast as you can just to stay in the same place. But that's not even the worst part, because 3.5% is the average inflation. But the things that actually determine quality of life are getting more expensive faster. Housing has grown from $170,000 to over $420,000 since 2000, about 4.8% per year. Healthcare, 4.55% per year, according to Peterson KFF. Education, 4.56% per year, according to the College Board. The things you cannot do without a roof, health, children's education, are getting more expensive faster than incomes are growing. And the things that pull inflation down: TVs, smartphones you buy once every few years, a hidden tax, invisible year over year, devastating over a decade. And that is exactly why many have the feeling that on paper everything is fine, but in reality there is less money. You aren't getting poor abruptly, you are getting poor gradually, almost imperceptibly to yourself. Every year the difference seems small, but over time it turns into a chasm between income and expenses. At some point, you realize it's not that you earn too little, it's that the system is playing against you from the start. And the longer you ignore this difference, the more it accumulates and pressures your financial reality. You might feel like you are doing everything right, working, trying, but the result still slips away. Because without changing strategy, you remain in a game where the rules were not in your favor to begin with. This holds the most dangerous part, the illusion of stability, which prevents you from changing course in time. You get used to the gradual decline in purchasing power and start to consider it the norm. But the reality is that every missed year reinforces the gap and makes recovery harder. The sooner you realize this, the chances you have to turn the situation in your favor. Why the government doesn't want prices to decrease. The Fed has an official inflation target, 2% per year, not zero. They intentionally design the gradual depreciation of your money. Why? Because deflation, the decrease of prices, is historically more dangerous. If you know that a car will be 5% cheaper in 6 months, will you buy it today? Most will wait. When everyone waits, consumption collapses, business loses revenue, layoffs begin, and people spend even less. A deflationary spiral. Japan went through this in the 1990s. The lost decade stretched into 2.5. Prices fell, but the standard of living did not improve because there were no jobs or income. From this follows one practical conclusion. Prices will never return to previous values. This is not a bug of the system, it's a feature. And if you don't build your finances taking this into account, the system will quietly destroy your financial future. Inflation in this model is not a mistake, but a tool that keeps the economy moving. It forces money to circulate rather than sitting as dead weight in accounts. But at the same time, it invisibly punishes those who just save without investing or increasing income. In the long run, the winners are not those who work more, but those who understand the rules of this game. Because in a system where money depreciates by default, inaction is a guaranteed loss. This is why safe storage of money often turns out to be the riskiest strategy. You can avoid risk on the surface, but accept it in a hidden form through the loss of purchasing power. The only way to change this is to stop playing defense and start acting with an understanding of how the system is built. What specifically to do? 4 steps. People who understand this mechanism are not the ones it crushes. They are the ones who make money from it. Step 1. Own assets that grow with prices. Cash loses purchasing power every year. A savings account at 4.5% barely keeps up with real inflation after taxes. What grows along with prices? Real estate, stocks, business. If you bought a house in 2000 with a fixed mortgage, the payment is frozen at the 2000 level, while the asset grew with inflation. You are on the right side of the ratchet. The S&P 500 has given an average of 10–11% annually over the last 30 years. Subtract 3.5% inflation, still 6.57% real return. $500 a month, starting at age 25, with a 10% return by age 55. That's $1.13 million on an investment of $180,000. The companies in the S&P 500 are the ones raising prices. When you own their stock, you are sitting at their table. Step 2. Grow your income faster than inflation. If prices grow by 4% and your income by 2%, you lose 2% of purchasing power annually. No coupons will fix this. Invest in skills with market value. Negotiate your salary. A Carnegie Mellon study showed that negotiating a starting salary yields an average of $600,000 in additional earnings over a career. Changing employers gives a 10–20% increase versus 3–4% for a promotion at the same place. Step 3. Use fixed debt strategically. A mortgage at 6.5% for 30 years. Your payment is the same in year 1 and year 30. But the dollar in year 30 is worth much less because of inflation. Inflation devalues your debt and simultaneously increases the value of the asset. This is exactly what wealthy people do. Borrow at fixed rates, buy growing assets, and let time do the work. Just not credit cards at 24%, that is a disaster. Only strategic, cheap debt to acquire assets. Step 4. Embed inflation thinking into every decision. When evaluating an offer, ask, is this salary growing faster than inflation? When thinking about renting or buying, consider that rent in 10 years will be much higher. Keeping money in an account at 0.5%, you are losing 3% of purchasing power a year. This is not a neutral decision, it is an active loss. And that is all the difference between those who are constantly catching up with life and those who gradually begin to outpace it. They don't wait for the perfect moment or hope that the system will suddenly become fairer. They simply align their decisions so that time works for them. Because inflation punishes passivity but rewards those who take the right position in advance. Prices never come back down, not because of one factor. The central bank wants price growth. Corporations use crises to expand margins. Wages do not decrease. Consumer psychology adapts to high prices. And no politician will win an election on the slogan, "I will make everything more expensive for your own good." The system is self-sustaining. It will not change. The strongest thing you can do is stop waiting for the system to fix itself and start making decisions based on how it works. Buy assets. Invest steadily. Take debt strategically. Grow your income. Don't hoard cash. Don't wait for prices to drop, because prices will never fall. Here is my challenge to you for this week. One specific action that puts you on the right side of inflation. Open a brokerage account. Research market salaries. Calculate how much your savings will be worth in 20 years in real money. Nothing motivates like cold, concrete numbers. Every month you wait, the ratchet clicks one more tooth forward. It doesn't turn back. The sooner you realize this, the less time you will lose trying to wait for a better moment. Because a better moment doesn't exist, there is only the decision you make now. Small actions today create the financial reality you will find yourself in years from now. Either you use inflation as a tool, or it will slowly use you. Subscribe to the Sem Invest channel if this was helpful. Write in the comments, which price increase in recent years hit you the hardest? I read every comment. See you in the next video.